Key accounting issues is what we're covering today. And this is quite a topical question. It comes up in section B and it tends to be question 4. So question 4 can either be on interpretation of accounts for investors, or it can be on some key accounting issues or changes in regulation. So often there is a wordy bit which is kind of pure knowledge, and then there's application to a scenario. And so the wordy bit, which is pure knowledge, we just, it is part of the syllabus, but sometimes it's just like, where did that come from? But what we can do with the difficult scenario is break it down and show you that there's no right answer. As long as you apply yourself, there's no right answer. There's a better answer, but it's best to keep it simple and think in simple terms. So let's just go through some of the key accounting issues which are in your area. This used to be called current issues, but nicely nowadays they're calling it key accounting issues, and they've actually put them in the syllabus. Whereas you used to have to just guess, absolutely just guess what the current issues were by reading magazine articles or technical articles. And so this is really nice because they focus now in on what they're going to test you on. Okay, so let's go through the key accounting issues. So first of all, cryptocurrencies. Nobody likes them because nobody understands them, but let's try and understand them. So cryptocurrencies, they're a virtual currency, and they're not issued by a central authority, so they're outside governmental control. They can be used to purchase goods and services, although they're not widely accepted, and the market value is highly volatile. As we know in the current terms, so if you're watching this video other than in 2025, in spring 2025, you may be thinking, what is she going on about? But at the moment, cryptocurrencies are definitely volatile because of the tariff issue that's going on in Trump Towers, shall we call it. So they have been going through the roof and now they're dropping. So what is the accounting treatment as investments? They're basically investments, aren't they? People are investing in them. But what we've got to think about is cryptocurrencies are not cash, because they cannot be readily exchanged for goods or services. So think about this in terms of financial reporting, not in terms of the substance of them at the moment. So in terms of finance reporting, we have strict definitions for things. In cash, they're not readily exchanged into goods or services. They're also not cash equivalents because there's a significant risk of change in value. Remember, cash equivalents are short-term investments, which cryptocurrencies are, but they have to have no significant risk. And of course, cryptocurrencies do have a significant risk. Financial instruments, because there's no contractual right to receive cash, or it's a residual interest. So a contractual right to receive cash would be a financial debt asset, but to receive a residual interest in an entity would be a financial equity asset. So it's neither of those. So what is it? Well, the technical article says it's an intangible asset, potentially. And okay, so if it's an intangible asset, what two models are allowed under IAS 38? Does anybody remember? You can write in the chat. Do they remember anything about IAS 38, intangible assets, the two models that you're allowed to use? Can anybody tell me? Come on, somebody must know. I'm going to wait until somebody can say it. So, okay, give you a hint. Cost and fair value, Joe. Well done. It's not fair value, but it's revaluation. But at least you answered, and that's brilliant. It's the cost model and the revaluation model. In the same way, IAS 16 has the cost model and the revaluation model. So let's look at the cost model then. Now that's unlikely to provide, let's think about this, to our shareholders, useful information, as there's a large discrepancy between the carrying amount and the fair value. Cryptocurrencies are volatile, and therefore they're going to affect the cash flows by being sold at fair value. So really, we shouldn't be holding them at cost. That's not relevant and it doesn't show faithful representation to our shareholders. But what about the revaluation model? Under IAS 38, all revaluation gains need to be reported in OCI, even though most standards require trade investments to be measured through profit or loss. So again, IAS 38 is not really appropriate, even though we can see it as an intangible asset. We kind of need to make our own standard from it. So that's where we fall back on the conceptual framework. So the conceptual framework gives us this framework for looking at something which doesn't have a standard. And cryptocurrencies don't have its own standard. And I suspect it's going to be coming soon. Okay, watch this space. But let's go through the conceptual framework, the 4 steps that I want you to go through. First of all, is it an asset? Well, absolutely, because it's got the potential of producing economic benefits and it's traded. Can it be recognised? Well, is it relevant to be recognised, and will it offer faithful representation? Well, of course it's relevant and it offers faithful representation to investors because they've got an asset which is traded and it will affect the entity's future cash flows. So therefore recognition is appropriate. Well, how should we measure it? Well, the 2 measurement bases are historic cost. We've already said historic cost is not relevant. So current cost is the only other measurement base. And of course, entities sell cryptocurrency in order to benefit from the fair value gains. So therefore, we should be measuring it at fair value. What do we do with those gains? Should we put it in the P&L or other comprehensive income? Well, the P&L is the primary source. And in the same way that we do fair value gains in our investments that we trade, we all through the P&L, we only put investments gains through OCI if we're not trading them. So why would we do the same for cryptocurrency? It's a short-term sale, it's highly volatile, and shareholders need to know that those gains are there or those losses are there and they're going to be realised. So in conclusion, I would actually personally see this as a financial asset, even though they've discounted it. It would seem that crypto asset is a asset held at fair value through the profit and loss, and it will provide the most relevant information about its economic performance in the period. So that is using the conceptual framework. But if we use the IFRS, the only relevant IFRS would be as an intangible asset. But that intangible asset doesn't have a measurement base that really fits with what the substance of the cryptocurrency asset is for us. So hopefully that's clear. Is that good? Is everybody happy how that would work in an exam question? Just so that you can see that. It's presenting an argument, keeping it simple, and following a process. So just give me some feedback to let me know that you're on with that. You can put a thumbs up. Thanks, Joey. Yeah, good. Okay. Checking everybody's still with me. So now also we need to look at the other side. So just checking that you're understanding. When I was talking about the cryptocurrency previously, I was talking about the asset side, it being somebody who is investing and buying a cryptocurrency. But of course, you also, as with financial instruments, you need to look at the actual financing side or the person who's issuing it. Now, it's initial coin offers is what we call a cryptocurrency from the financing side. And it's the raising of finance through cryptographic assets. So investors will buy into the initial coin offers and then receive tokens in exchange. So it feels like equity. But we need to go through again and understand what this really means. The tokens may entitle the holder to cryptocurrencies, or it may entitle them to utility tokens, which provide users with access to a product or service. Or they could be security tokens, which provide an economic stake in an entity or the right to receive cash or assets in the future. So depending on what the nature of that is, depends on how we account for them from the credit point of view. The debit point of view is the person who's buying it. The credit point of view is the person who's issuing it. So we now need to look at what they're doing. So here, when the entity raises funds via an ICO, it will obviously call the receipt of an asset as the debit entry, okay? So that being cash probably. So what is the credit entry? Well, that is dependent on the nature of the tokens issued. So if you get an exam question on them, you have to think about what they're saying in the scenario. So if they're issuing them, it could be a financial liability. And that's if the reporting entry is contractually obliged to deliver cash or another financial asset to the holder of the tokens. And that other financial asset could be shares, but maybe a variable amount of shares. Or it could be another financial asset like a preference share, or it could be a bond or a loan note. So something else is being given, so therefore it would be a financial liability. If it was equity, its holder is entitled to payments made out of distributable reserves, but there's no obligation for repayment. So it's a net interest in the net assets or the residual assets or income of the entity. And that's important. It has to be that for it to be considered equity. It could be revenue. So that's if the recipient was a customer and if there's a contract. And it could be that they're getting goods and services in exchange for that finance. So therefore, it ultimately is a revenue item. Finally, it could be a provision. If there's a legal or constructive obligation to the subscriber, then a provision should be recognised in the accordance with IAS 37. So it depends on what is behind that money being given as a receipt. And it may be that we might have to pay it back. But it's not a financial liability. It may depend on an uncertain event in the future. So therefore, it's more likely to be a provision. So it's looking behind that and thinking about those 4 types that it could be and using that in your answer if you're very unsure. So that's looking at cryptocurrencies from an asset point of view and now looking at it from a credit entry point of view. So being the first 2 being financing and the last 2 being one revenue and one a provision. So again, that's a topical thing. The other topical area is natural disasters. And these include things like volcanic eruptions, earthquakes, droughts, tsunamis, floods, and pandemics. The pandemic being the COVID thing. So there has been a flavour of questions about this because it has impacted quite dramatically on entities all over the world. So in SBR, they've decided for you to discuss what the financial reporting consequences are of a natural disaster. And so let's have a look at that. Let's think about what that would affect in a question. You've got to think about all the possibilities of what would happen, but not too many, but just focusing on a selection which would potentially be in the scenario. And the scenario will lead you to that. When we look at questions on revision, you will see that. So financial reporting consequences of natural disasters. First of all, the classic one is impairments of assets. So if property, plant and equipment is damaged, then of course you've got to test for impairment. Remember, you test for impairment with this evidence of internal or external potential impairment. And of course, a natural disaster, if something's damaged, that's automatically looking at whether it's impaired. Your demand for goods and services may be reduced. And so that's also evidence of impairment of the cash generating unit. And also productivity may decline. So that's an internal evidence of the fact that your assets may not have the higher value in use anymore. So again, just talking about that in your answer is enough to get the tick marks for those reporting consequences. Think about your inventories. It may lead you in the scenario to say that inventories have been damaged. Automatically, you say, well, we need to assess that for net realisable value. Insurance is always a classic. There could be insurance out there. There could be a grant out there for assistance, government assistance. So insurance proceeds would come under a contingent asset. And remember, it's only disclosed if it's probable. Only if it's virtually certain can we recognise a receivable for that. And that's very, very rare because insurers never give certainty. If it's on that vein, if it's a government grant, then of course, again, that becomes receivable when we recognise it. And so remember, it's government grants and government assistance is IAS 20. So that is why I would be talking about that. Restructuring is a classic one. You may need to restructure if you've had a natural disaster. So you may need to close down or make redundancies. And remember, you can only make a provision if you've got a valid expectation, which means a constructive obligation that you're going to go through with that restructuring. And it's only for things that are not continuing and nothing that is continuing. So redundancies are allowed, but relocation isn't, for instance. The classic one you need to also look at is the entity now a going concern issue. And that is always got to be talked about. So you may have breached covenants, you may be required to repay borrowings, and uncertainties will also be disclosed. And if it's really bad, you need to change the counts to be on a breakup basis. That is just a flavour of them. There are lots of other ISs and IFRSs which would come into this. You don't need to know all of them or pick all of them. You just need to be able to talk about some of them, which you can focus in on the scenario, and the scenario will lead you. So there is a technical article on this. It's a very good one. It's got loads of them in there. But if you read it, you'll remember it when you come to do your questions, because it will just trigger some, oh, yes, that was in the technical article. And there are technical articles on all of these areas which I've talked about in this section, and I've put them in the tuition section, in the tuition thing where you need to read them. Okay, so that's good. So brilliant. So those are the three issues I wanted to talk about. The final issue in this area is sustainability. And those sustainability standards are really gone through in the previous session when we're looking at interpreting financial accounts and non-financial reporting for investors. But sustainability seems to cross both of these areas. So that is obviously a current issue, shall we say, in these terms. Right, so let's now have a look at an exam question. So I'm going to go through an exam question on the practice platform, and it's called Cryptocurrency Symbol Company. And it's a part B question, and it's also part B to D I'm going through. I'm not going through part A. It's a section B question on this area. So let me swap to the practice platform. So here we are on the practice platform. I'm on September-December 2021. And I'm on question 4 of the exam, and it's for 25 marks. And it's called Symbol Company, and it says it develops cryptocurrency funds and is a leading authority on crypto investing. It specializes in initial coin offerings and raises funds from investors in form of cash or crypto assets such as Bitcoin. So this scenario is about raising initial coin offerings, but also investing in setting up platforms for the crypto investing. Okay. And then they've got these following exhibits available. They're talking about development costs. Well, when you have a heading like that, you should automatically be thinking development costs, intangible assets. Then it says initial coin offering arrangements. They've told you what ICO means. And you must be thinking about financing. Is it financing? What type of financing is it? Is it a financial liability? Is it equity? Is it revenue? Which one should we put it through as? Or is it something else? And then tokens granted to directors describes granting of tokens to its directors. Well, we can think about what sort of benefits do directors normally get? share-based payments? Or could it come under employee benefits? Is it part of salary? Is it a bonus? So you've got to start thinking about those headings and start thinking about what they might mean. So then we have a look at the requirements. And here are the requirements. I'm not doing part A, it's about disclosure. I'm doing part B, C, and D. So we advise the various development and promotional costs related to the ICO can be accounted for as an intangible asset. Brilliant. It's asked about intangible assets. So you should be thinking, IS 38, when can you capitalize an intangible asset? When you've got future economic benefits and when you can reliably measure it. That's the clear thing that comes from it. Have you got contractual rights to it and you've got future economic benefits? So that's one. And number C would be discuss how the receipt of a £1 million cash in the pre-sale agreement should be accounted for and how the 10 million raised on the ICO should be accounted for. So it's a clear distinction, the 1 million cash and the 10 million raised. Those would be my headings. As before, up here, I would say the same thing. Development costs and promotional costs would also be separate headings. And then finally, discuss why the granting of the tokens to the 5 directors are wonderful. They've given us the ISs. Which one should it be? Should it be accounted for in accordance with employee benefits and not share-based payments? So it's not as bad as you think. They don't leave you hanging. They give you some direction. Okay? Part B was an intangible asset direction. Part C is talking about financing. So you must be thinking from an equity and a financing point, financial liability point of view. And part D is talking about employee benefits and share-based payments. So you need to pull back that knowledge that you've got and use it to help you answer this question before you look at the nightmare of the scenario. But anyway, we'll laugh about that in a minute. So what you do here, everybody, is you open up your word processor, and the first thing I would do, so you can close down this requirement, is I would copy that into my word processor. And then you don't have to look at it again. So we're going to start with part B. So let's get part C out the way. And then we're going to do part D. And also the beauty of this is it's clearly labeling where you're going to, what you're answering, if you answer beneath it. And also you can see that it's for 5 marks. So we've got to get that one out the way. And then we're going to pull up the exhibit, bearing in mind you've got that little heading. So the first exhibit is here. And we'll read the question again. It says advise whether the development and promotional costs, so separate them out. We need the development costs as a heading and the promotional costs. Okay, should be accounted for as an intangible asset. Okay, so they've given us a diagram. I don't understand the diagram. I can see that an investor buys some tokens and they get issued tokens. And then there's a fee and there's a platform. Okay, right, okay, let's go. I'm sort of there, right? Then it says the terms token and coin mean the same as investors, and they're often referred to as supporters. Okay, so token and coin mean the same and investors are supporters. Okay, so ICO issues tokens to investors, so coins to investors for cryptocurrency or cash. For each ICO, so this is issuing a token, Symbol establishes a separate payment platform for which investors can trade the tokens. So we've got a payment platform. All right, so I'm going to highlight that. And these tokens do not represent an ownership interest. Okay, so that's interesting because I know there's another requirement telling me about that in the platform, and the company takes a percentage profit as a fee. So there's an income. Okay, there's an income. So it's not letting me do that. I don't want to do too much. Okay. At the 31st of March, Symbol has incurred significant costs in promoting. So these are the promotion costs and developing the trading platform with the purchase and sale of ICO tokens. These costs have been met from its own capital and expensed the P&L. It will earn revenue from supporting the purchase and sale of tokens. Okay, so go back to development costs. You're developing something. You're developing an iPhone. You're developing a new drug. You're just developing a product. This platform is also a product. But to pass the criteria for being able to capitalize, you must have future economic benefits and you must be able to reliably measure it. We can take it as certain that this is technically feasible and they've got the resources to complete. They've done it, it's completed, it's feasible. But what we are sticking to now is, can we recognize it as an intangible asset? And so you need to stick to the requirements of the standard. Is it going to give you future economic benefits? And absolutely yes, because it's going to earn revenue from it. It tells you here in the scenario. These costs be met from its own capital and have been expensed. They will earn revenue from supporting the purchase and sale of tokens. So your answer should be focused on, first of all, defining what intangible asset is and what's allowed, then saying, absolutely, it should be capitalized because there are future economic benefits and there's a reliable measure. And therefore, we can put it on our balance sheet or our statement of financial position. The second item is the promotional cost. But the promotional cost is an issue because promotional activities are not allowed. Anything to do with marketing and advertising is forbidden to be capitalized under IAS 38. So that's how I would build up my answer. Now, I'm not going to type it out because it's already there. So I'm just going to go through and show you where it is here. So let me just copy this back up and then we can pop it in and go through it. So the development costs of the platform, put in a separate heading. And then the promotional activity, I put in a separate heading. So these costs can be recognised if it's probable there are future economic benefits and the costs can be reliably measured. Otherwise, it should be expensed. Let's apply it. Well, it takes a percentage of profit as a fee, so therefore it's got revenue. I mean, it could even just say it's got revenue. And the company expects future economic benefits after issuing the tokens. The costs can be recognised as an intangible asset, and you must say what you're going to do afterwards and amortized over the useful life of these assets. You could also, if you want to check, make sure you've got more marks, is but say that you do have a reliable measure because the costs are evidence of that. You've got invoices and how much you've spent on developing the platform. The promotional activity is 1 mark for saying it states that the entity should expense the promotional activity when incurred. It's not allowed. Something to that case that marketing and advertising expenses are never allowed to be capitalized because you can't assess the future economic benefits. If you wanted to write that, you can write that too. I am just trying to get you to keep it simple, keep it brief, keep it focused. So let me have some feedback on that. Do you think that is doable, bearing in mind what you saw, that awful diagram, which sent me into a spin? Can you see the wood for the trees now? Anybody? Right in the group? Yes, Matteo, good. Yes, Jerry, that's good. So I'm hoping to try and keep it simple, and therefore you can use your language, will still get marked. This is kind of the model answer language, but breaking it down and stripping out too much of the fluff. I don't want any fluff anymore. I want it focused and kept simple. Okay. Right, so part C. Let's now shut down this and go on to part C. So this is the ICO arrangements. So remember this, you've done your revision, you know what an ICO is, you know it's financing, it could be liability, it could be equity, or it could be raising revenue, or it could be income, or it could be a provision. Let's look at what's going on here. So read again, it says the receipt of the 1 million cash they want you to talk about, and also the 10 million raised on the ICO. So occasionally Symbol enters into pre-sale agreements to raise funding from selected investors. The Symbol has entered into a pre-sale agreement which entitles the investor to a 10% discount for the price of tokens compared to others. The investor paid him $1 million in cash. The issue date of the ICO is a month away from when he received this cash, and the cash is only refundable if the ICO is abandoned before the 30th of April, because of the minimum funding level has to be 9 million has not been achieved. So we need to talk about what we do with that 1 million in cash. So the 1 million is what we're talking about. What do we do? Well, debit entry is cash. It's the credit entry that we need to deal with. What do we think about this? What would you credit? Because you've got to think about, you're not, you're receiving that, but you might have to pay it back. So you've got to see it as something that is contingent or uncertain. That's what I think. I'm thinking it's contingent or uncertain. We don't know whether the ICO is going to be abandoned. And if we abandon it, then we're going to have to pay it back. So you've got to think, whoa, that is a provision. That's a provision potentially just for a month until we know the outcome of the ICO. The outcome of the ICO has nothing to do with us. We can't change that. So this is going to be a liability of uncertain timing and amount. Do we actually have to give it back, or are we going to be able to keep it? So the best thing to do with this one is to say it's provision. Now, if you didn't say it's provision, you could think to yourself, well, it's financing, so it could be a financial liability, or it's equity financing, so it could be an equity liability, or it could just go straight into income. Because you think on balance, it might not be a provision that you have to pay back. So you could talk about it like that. You could say, this is just income. I don't think it's not probable that I have to pay it back. So therefore, I'm just going to keep it in income. Whatever you decide, as long as you argue the case, then that's the best thing to do. So let me go down and I'll pop in what we think it is down here. And I shall pop it back up and talk through. What I'm trying to get across to you is whatever you put down, if you argue your case and it's sensible, you'll get the marks. So on the basis that the occurrence of the successful ICO is beyond the control of the entity, it contains a financial obligation because it represents a contractual obligation to deliver the cash if the ICO doesn't go ahead. That's what you want to be saying. Now, if you'd said, like I said, oh, it's a financial liability, we may have to pay it back, that'll be enough. Contractual payment. Right, this is beautiful language. Might change that a bit and just say it's beyond the control of the entity. Therefore, the agreement is a financial obligation because you've got to deliver cash. Right? I would just put that, to deliver cash. Leave that out. If the ICO doesn't occur, much simpler language, we'll still get the marks. At the 31st of March, however, the 1 million is viewed as a financial liability symbol, and this is reversed if the ICO is successful or refunded if not successful. So they've said it's a financial obligation. I described it as a provision. Both of my answers will be perfect. Okay. So financial obligation, you could have argued it might be an equity, not really equity because you don't need to repay it, or it could be a provision. So either way, the answers would have been okay. So that's the model answer. Okay. The next bit is the 10 million. So let's now look at the 10 million. Once the tokens are issued, investors can readily convert them into cash or cryptocurrencies, but they do not entitle the holder to future goods and services other than supporting the purchase and sale of tokens. So it's not revenue, okay? Now, the inflows received for the tokens are used to fund future development of the payment of the practice platform. So it's income for future development of the practice platform. That's what they're using it for. Going down, it says that they've made a commitment to the holders of the tokens to pay a single payment of 10% of annual profit for the year. But the holders, which is the key term here, the holders do not have rights such as redemption or any residual interest in the assets of Symbol. And they raised 10 million. So with the 10 million, you've got to go through and think, it's not revenue because there's no future goods and services around. But is it a financial liability? Well, they don't have to redeem them. Is it equity? But they don't have residual interest. But what about that payment, that 10% profit? That makes me feel that there's a fixed dividend type thing coming ahead, which kind of is variable. You could argue that it's potentially a financial liability that you don't have to repay because potentially you've got some liability for that 10%. The trick is to go through and think about it and then come up with a reasoned argument. Well, in fact, the answer is it's not a financial liability because there's no contractual obligation to repay. It's not a residual interest, so it's not equity. What it is simply something like a grant that they're receiving, some funding that they're receiving in lieu of the platform. And they're going to get a payment effectively of 10% from profits. So again, I could still argue it's like a loan, but the answer doesn't say that. But if you'd have put it down as a loan and made something like saying that's like interest, that's like 10%, I would have marked it right. But let's have a look at the real answer. I'm hoping that you're not thinking, oh, I'd have definitely put it down as a loan. And if you did, and saying, oh, I'd get it wrong, well, you wouldn't get it wrong because you've argued your point. The funds are paid. Oh, I missed that bit. Should be there. Sorry. The funds paid by the holders of the tokens, 10 mil, have a one-off right to 10% of profits for the year ended, but they do not have a right to redemption of the assets or a residual interest. So due to this reason, it should not be recording as a financial liability or equity. But you need to record it like a grant. I think it's like an income grant. This is what they're saying. So they do a lovely journal for you. Debit 10 million, bank, credit, financial income. The 10% will be a liability as profits made. That's not in the model answer, but I feel that that was something worthy of saying. You need to say something about that 10%. Becomes a liability when it becomes payable. They don't know whether they're making a profit, but if they do make a profit, that's when it becomes a contractual liability to pay it. So I see it with the model answer, of course, as effectively like a grant. But if I'd been doing this as a student, I absolutely probably would have said it's a financial liability because it's a bit like interest. But then you've got to stick to the wording, haven't you? It's not really a financial liability, so it's almost like an irredeemable, I think, irredeemable preference shares. It's a bit like that, I think, irredeemable preference shares, which you would actually put in equity. So I would argue the case for that, but this is the model answer. Think about what would you do, team? What would you think it is? I mean, what would you think? Would you think it was a loan, or would you think it was almost like irredeemable preference shares? Or would you actually think it's equity? Which one would you have potentially argued? You definitely wouldn't have said it was revenue, I hope. What do you think? Anybody? Whatever you say, yeah, Matteo, I think it would have been irredeemable preference shares for me, acting a bit like that. Because they're not a residual interest, but they act like equity. Okay. Anybody else? Okay. Valentina, what do you think you would have said? Equity. Yeah, bit like equity, yeah, even though it says it's not a residual interest, that 10% profit to me was indicating that it's variable, yeah, which acts a bit like variable dividends. So whatever you did, as long as you argued it and you would have done well. So let's look at the final one, which is D. We'll pull up tokens granted to directors. So we've got tokens granted to directors. So let's read it. Discuss why the granting of tokens to the 5 directors should be accounted for with IAS 9 employee benefits. Now, employee benefits, not just about pensions. Don't fall into that trap. It's about salaries, holiday pay, non-cash benefits like cars, all that sort of thing, bonuses. And it's also long-term benefits. It's also about termination benefits and redundancy benefits, obviously. So it's all about employee benefits, but don't just think about it being pensions. Rather than IFRS 2, which is share-based payments. Now, share-based payments, remember, are either equity-based or cash-based. Okay? So we need to think about that in the context of this. So my model answer doesn't think about it being cash-based. It only thinks about it being share-based. But don't forget the share cash is based on the share price. So that's why the cash-based payment is still a share-based payment. So you've got to think about the rules with regards to that. But it's clearly saying to you it should be accounted in accordance with employee benefits. So we've now got to argue why it isn't a share-based payment. So let's look at the scenario. Symbol sometimes does not issue all the tokens from an ICO to investors, but retains some to reward the employees. Nice. So on the 1st of March, Symbol granted tokens to 5 directors. So as soon as I see something like that, granting tokens, I think, ooh, a share-based payment. But it's told us it's not. The awards vest, again, there's a vesting period on the 31st of March. So that's a month. Remember, that's only a month. That's less than a year. To investors who were in Symbol employment by the 31st of March at XT7. The tokens give the directors the right to receive a car of their choice up to a value of 50,000 at any time in the next 12 months to the 31st of March. So they're going to use those tokens to get a car. Right, so all 5 directors were still with Symbol on the 31st of March. So all the directors are going to get this. So why isn't it a share-based payment? Well, because the tokens are not equity. They're not the right to a residual interest in the entity. So therefore, they're not shares. They're not, that money, that 50,000 is not based on a share price. It's based on a token. And as the tokens aren't shares, then they can't be share-based payments. And so they are effectively a bonus, a short-term bonus, because it's within a month. And so how do we account for it? Well, we value them based on the fair value of the item that they're getting. And so the fair value of the item that they're getting is 50,000. So we base it on the 50,000. And of course, there's 5 directors, so there's 50,000 times 5. So pop in the answer. First of all, you say, unless the ICO tokens meet the definition of equity, then they won't be a share-based payment. So we clearly have to say that they're not equity. So the tokens are not equity, as they do not grant the directors a residual interest in the net assets of Symbol. The arrangement is simply a bonus, that's what I would call, for employee services. And it includes a condition that they've got to remain in employment. So we need to reckon, so Symbol should recognise a liability and an employee expense, and you would measure it at the amount you expected to pay for the goods and services. Because if you remember, share-based payments, a little bit like the same language we would use. So it's basically you have a fair value of the item, so therefore you're going to value the tokens at that fair value. Otherwise, you'll have to use the token value on the crypto exchange, but it's more reliable because you're actually giving them the value up to 50,000 because you're getting them a car. So therefore, we value them at the 50,000 and we debit employee costs and we credit short-term employee benefit liability until they take up the offer. So that was for 6 marks. So it's important to see where you're getting your marks from. So you've got to make sure you make 6 points. So the first point is saying the knowledge. The second point is then stating your opinion. The third point is, what is it therefore? It is a bonus. And then we talk about how we account for it, which would be the other 3 points, including the journal. So you don't need 6 marks from this point. You don't need 6 marks from this. But what you do need is 4 out of 6. And this one's 5 marks. And so you need at least 3 marks from that. So don't beat yourself up if you wouldn't have got all the marks. But what you've got to do is just keep putting sensible points down, backed up by IFRS or the conceptual framework. And it must be applied to the scenario and answering the requirement. I'm not asking for much, am I? I know you're all thinking, yes, I am. But if you can break it down and keep it simple and keep it focused on the requirement, don't get distracted. You will do well and you'll get enough marks out of each section. The other thing you must do is do not overspend time. Okay? Do not spend too much time. 5 marks is 10 minutes. 6 marks is 12 minutes. And this one is another 6 marks. And that would be another 12 minutes. Now, you may spend more time on one that you know more about and less time on one you don't know about. Remember, the harder marks come at the end of your time. So if you're going over time, you mustn't. You just move on. Move on, because you're going to get easier marks elsewhere in the exam. So that's the end of my walkthrough of what I think is quite a tricky topical question, just because we don't really understand cryptocurrencies and we don't really understand initial coin offers. But within that, they had development costs and they had employee benefits. Okay. So let me know in the chat how you got on, and we will have to end this live tutorial. So well done everybody for listening, and thank you for attending.